Good evening, everybody. Welcome to this public lecture hosted by the Centre for the Study of Governance and Society. My name is Mark Pennington. I'm the director of the Centre. This lecture is part of our ongoing series on the political economy of knowledge and ignorance. And the particular challenge of knowledge and ignorance, or decision-making under uncertainty, if you like, that is the focus of this evening's presentation, pertains to monetary policy and the challenges that face central banks. So I'm delighted to have with us this evening Professor Willem Buiter. Willem is currently the Adjunct Senior Fellow at the Council on Foreign Relations. He has previously been Chief Economist and Special Counsellor to the President of the European Bank for Reconstruction and Development, and he was an original member of the Bank of England Monetary Policy Committee. Willem has also held academic positions at Yale University, the London School of Economics, Cambridge, Bristol and Princeton University. So without further ado, I'd like us to all welcome Professor Willem Buiter to speak about four informational challenges facing central banks.
Thank you very much. It's an honor and a pleasure to be here. I have, as usual, too many slides and too many words on many of the slides, so I'll go through them quickly, skip quite a few completely, but don't worry, the presentation will be made available afterwards, so if you feel that you like to see the unseen, that will be possible. It's a pleasure to be here, especially because I've been in this building before, but it was its previous incarnation as BBC World Service. And of course, I worked on different occasions across the street from here. It's a real pleasure to be here. And, let's see whether I can make this work. Yeah, here we go. Never been a more fun time, I think, to be a central banker. It's very challenging, but when you do a job like that, you want challenges, and we have them. First, they have to relearn how to control inflation when confronted with a range of supply shocks and combined demand and supply shocks. And these can be sudden shocks and temporary ones, COVID, Ukraine, or gradual and secular, demographics, deglobalization, climate change. Second issue I want to talk about is the enhanced lender of last resort and market maker of last resort that the central bank has to be in a world where increasingly intermediation is no longer through banks, but through the non-banking sector. This vastly complicates the pursuit of the financial stability mandate, which is the primary mandate of every central bank. Whatever they may have on the official list is inflation or inflation and maximum employment. Financial stability comes first because it's a precondition for the other two. Managing the digital transformation is going to be a huge challenge. I am concerned myself about the potential impact of quantum computing on security in electronic systems in general, not just for central banks, but across the spectrum. And nobody seems to be focusing on that. Central bank digital currencies, they're coming. They have come in some places already, and they better get it right. And then the whole issue of decentralized finance, DeFi, cryptocurrencies, crypto assets, how the stuff needs to be regulated. And finally, the challenge of resisting fiscal dominance, what I would call fiscal capture, that central banks, despite being notionally operation independent, are forced to exercise their capacity to fund the sovereign and monetize government debt to an extent that is incompatible with the targets. So there's some additional issues for emerging markets and developing economies for central banks. One major challenge is, of course, the absence of an effective domestic lender of last resort, a market maker of last resort, because the economy is often heavily dollarized and in some countries also euroized. Right? So the market maker of last resort has no tools to work with. And and cope with the disruptive impact of advanced economy financial tightening through the foreign exchange markets and cross-border capital movements. But that's an issue that is mainly emerging markets, although as in the case of Iceland, we saw in 2009 and 10 that these problems can arise even in supposedly advanced economies. Okay, relearning inflation control. Central banks all over the world, in the advanced economies I'm talking about now, have missed the boat. It's a year and a half now since this high inflation started, and we still have policy rates, right, short term, right, not even in real territory, technically anywhere, and almost in the US, but certainly not in this country. There was something to the temporary and transitory narrative. There was a statistical base effect. Right? There were permanent labor supply reductions as a result of the COVID pandemic. 1 million people, excess mortality, right? In the US economy alone. Russia's invasion of Ukraine, and it was not anticipated, but it was anticipated once it started as being short and temporary instead of protracted and possibly at risk of going an unpleasant distance. There are lasting supply side effects of COVID. We have deglobalization, bifurcation of the global economy, reshoring and friendshoring. It all weakens potential output. It may give greater potential output growth, I suppose, the first moment, the growth rate. It may ensure against risk, but at the expense of the underlying growth rate. Building redundancy into supply chains, demographics, climate change and the public and private response to it, all that had an adverse effect on potential output that central banks simply have not recognized. And this is why we are in a situation still of persistent excess demand in most advanced economies, including the UK, including the Eurozone, including the US. And this is can only be addressed in one of two ways. You either boost aggregate supply, central banks can do rather little about that, or you reduce aggregate demand further. And they have the tools to do it, but they aren't doing it at the rate required. Okay, just the data. Unfortunately, I don't come out until Friday, the March PCE deflated data for the US. So my statistics there are a month out of date. But the most conservative estimate of inflation, core PCE deflation, is still running at 5.6%. And I doubt whether the Friday figure is going to give us something significantly lower than that. Headline, yes, will have come down further. Core, no. Euro area, again, it's pretty poor. The core inflation, 5.7% in March. And what's their interest rate? 3.5%. I mean, what planet do they live on? UK. I use the CPIH indicator as the best measure of core underlying inflation. It's also the most conservative one, but still 6.2% in March. And then even Japan, the country where inflation was supposed to have died, we've seen a resurrection. The core inflation in Japan is actually what they call core inflation. The regular core inflation doesn't take out energy costs. So core in March, 3.8%. So they're 1.8% above target and still at minus 0.1% for the policy rate. So again, which planet are they in? Next one. Oops. The good news is inflation expectations have not yet become detached in the medium and long term. This is true in the US. It's true in the Eurozone. And in the UK, the long-term measures of inflation expectations in March we're still, for 5 to 10 years, at 3.7%, which looks high until you realize that even pre-COVID, this particular index, the City YouGov survey, price expectations, pre-COVID, in an era where inflation was persistently undershot in terms of the target, we had inflation between 3 and 3.4%. So it is not much higher than it was before the COVID crisis hit. So the lesson there is that the time to act is now, because if expectations get translated into wage and price formation, we will have to go through a more protracted and extended period of excess demand, excess supply, demand deficiency, recession, in other words, in order to get inflation out of the system. I already said that the rates are still barely positive in the US, if you're very generous. Not if you use my core measure, it's still like that. The neutral policy rate is 2.5% in my estimation, given a neutral real rate of 0.5% and an inflation target of 2%, right? But we see that all the central banks fall, I think, well short of their target. Now, where should the rate be? A useful benchmark, which we can then contrast with these numbers here, is given by the Taylor rule, right? Which says that the policy rate at time t, I subscript t, is the neutral rate, what the policy rate would be with inflation on target and no output gap, right? Which is 2.5% in my estimate, of this 2% inflation target and a neutral real rate of 0.5%. That neutral real rate is a guess, right? It has massive uncertainty attached to it, but I doubt whether it's whether you can confidently say it's very different from this. So it says that the policy rate should be the neutral rate plus something that increases with the excess of actual inflation over target inflation, with a coefficient, a response coefficient, greater than 1.5 in fact in the original Taylor specification. That means that if the inflation rate goes up, if actual inflation goes up, the real policy rate goes up, because alpha is greater than 1, alpha is 1.5. And then beta times the output gap, which is playing less of a role at the moment, because I'm generously assuming that we have no large positive output gaps in any of the advanced countries I look at. If you apply this, this was, when was this? In February, just a year ago. Charles Goodhart got the US rate at should be over 6% and the UK about 5%. My numbers are here. Here we have the first row of figures you see is what the Taylor rule tells you the policy rate should be. In brackets behind it, we have where the policy rate actually is. And then the next 3 columns are the components which you can think of it if you don't agree with my assumptions here. 1, the assumption common for all 5 countries of the neutral rate, 2.5%. Then the gap between actual and target inflation, which I take as the difference between actual inflation measured on the most conservative core metric that I can find in the book. So I'm not trying to overstate the curve here. As regards the output gap, I generously say no output gap in the US, no output gap in the Eurozone, 1% output gap negative in the UK, which actually is doubtful actually, and if we took that to 0, that would raise the policy rate that is required according to the rule by 0.5%. The Bank of Japan, right, should, according to this specification, be at 4.7% with its policy rate. So the biggest discrepancy is in the Eurozone, followed by Japan, and then by the UK, Canada, and the US. Now, why aren't we there? Or what's wrong with this? Well, the Taylor rule ignores financial stability considerations, including, and it's very important in small open economies, and especially in small AMDEs, the external consequences, which are not taken into account sufficiently, of radical rate hikes on the rest of the world. So the solution to that is to replace this static Taylor rule, which I showed you here, with a dynamic Taylor rule, which says, well, yeah, the actual rule is actually a weighted average of where it would be if there were no adjustment cost, and with the weight gamma, and then a weight 1 minus gamma on the past interest rate. And if gamma is small enough, you would make this function consistent with the absence of any real rate hikes for an extended period, despite the policy rate being, so the actual inflation rate being well above target. Now, but even this, you'd have to come up with a tiny value of gamma for it to fit the data since the second quarter of 2021, which is when the problem started. Why are central banks still behind the curve, both as regards interest rates and as regards balance sheet size? Well, persistent errors in analysis and forecasting. Learning is not taking place fast enough. They're working with the wrong models. There may be a fear of domestic financial instability being a result of rapid policy hikes and large asset sales. We've just seen the Silicon Valley Bank implosion as a result, well, of internal screw-ups, but also of massive mark-to-market losses on their portfolio of long-dated securities caused by the Fed's quote aggressive, unquote, rate hike policy. I think the Fed has actually been modest, and the rest of the central banks have been more than modest. They've been inert. International repercussions, I've already talked about that. Fear of complicating the funding of fiscal deficits and adding to the interest burden of servicing the public debt. Fiscal capture, fiscal dominance. And finally, the hope that simply by waiting it out, inflation would take care of itself. Unwillingness to create the slowdown in aggregate demand and the recession, which I view as an inevitable instrument for getting inflation back to target in finite time with positive probability. Okay. Now, to financial stability. It is or it should be the overriding mandate of any central bank. The lender of last resort provides funding liquidity, mostly to banks, but possibly to other targeted institutions, mostly regulated entities, to selected counterparties against selected collateral. And a prime example is the recent bank term funding program introduced by the Fed to deal with the consequences of the SVB and signature bank failures. Big construction error in that facility as well. It does not make things available at penalty rates, at penalty prices, which it should do, but it doesn't do. The market maker of last resort provides market liquidity through outright purchases of selected financial instruments. And they are increasingly important since more and more financial intermediation takes place through the capital markets rather than through banks. Now, you might think that market illiquidity can only be addressed by the market maker of last resort through outright purchases. But that's not necessarily the case. The lender of last resort can target the normal would-be purchasers, including the market makers, the normal market makers, or first resort, right, who are able and who may be enticed back in the market on suitable terms by the central bank lending to them. So they do outright purchases. And for a number of markets, that is possibly a better way to proceed. I won't go through all the examples here, but I like as an example of how specific programs can fulfill multiple roles, sometimes at the same time and sometimes sequentially evolving over time. Take the asset purchase facility, created in 2009 as a market maker of last resort to buy high quality private assets. Now it's the main instrument for quantitative easing and quantitative tightening policies. Most of the balance sheet of on the asset side is APF. The Bank of England corporate bond purchase scheme, again a market maker of last resort, is part of the APF. The Bank of England's COVID corporate financing facility, which purchased commercial paper outright. We saw the Bank of England's emergency purchases of long-dated gilt from September 28 to October 14 to address the liability-driven investment crisis, which caused what is normally one of the most liquid markets in the visible universe, the long-dated gilt market, to seize up. The creation of the transmission protection instrument by the ECB, which is supplementing, or I think rather substituting for, the not yet activated outright monetary transactions. The TPI also has not yet been activated. They are there, lurking, and I think their deterring function has been quite effective. Okay, and there are other examples you can make sure themselves. What are the lessons learned? First, finance is inherently unstable. It is too serious a matter to be left to the markets alone. Right? So market makers of last resort and lenders of last resort have to be on standby in a permanent capacity. They have to be, they can't be, they shouldn't be ad hoc arrangements. They should be standing facilities, sorry, not on standby permanently. In practice, central banks who have to do the job aren't able to distinguish between liquidity crisis due to self-fulfilling panics driving self-fulfilling crisis, and one that is due to sound fundamentals, right? So the lender of last resort and the market of last resort will inevitably take counterparty risk, market risk, and credit risk. And they will have to therefore, I think, be backed by and fiscally guaranteed by, fully compensated by, the Treasury and the Ministry of Finance. We've seen this as an example, the Swiss Central Bank supports the Credit Suisse in March 2023. Actually, the Bank of England has an agreement, of course, with the US Treasury that if its capital falls below the lowest threshold level, it is being recapitalized to the middle threshold level by the Treasury. This is an arrangement which existed even before the great financial crisis. And it is one of the few central banks that explicitly has this agreement with its beneficial owner, which is the Treasury. Another important lesson is that you can only be a lender of last resort and market maker of last resort if you can price, have the knowledge to price illiquid assets in illiquid funding markets, and if you have the ability to do so even when there is no market guidance, that market prices either have completely disappeared altogether, or when the gap between bid and ask spreads is so large that neither one should be taken seriously. So this means the modeling capacity for a whole range of normally liquid but occasionally illiquid assets, the modeling capacity has to be, I think, significantly stronger than is currently the case for most central banks. So more jobs there. Okay. A further lesson. Okay, you can't do much when you have foreign currency denominated loans and financial instruments. Argentina, Sri Lanka examples. Sometimes you have to buy some investment grade securities. Credibility is key. And finally a lesson, which is sort of separate really, but don't add to financial market confusion and unrest by making additional tier 1 bonds junior to ordinary shares, right? That's lesson 1, even if it's legal, and undoubtedly they check the small print, right? It is such a violation of economic and market logic that it really will impair that market for years to come, if not longer. Open questions. Should the central bank intervene in equity markets? The Bank of Japan has done so. My view is that it's possible better to stay out of it, since ownership and control issues really become a serious matter. And should the bank even interfere in certain key commodity markets? Answer there is probably not, but if they do, they should do it indirectly, as lender of last resort to the absentee normal purchases, including the absentee market makers, rather than outright purchases of commodities by the central bank. I can't really see the central bank holding commodities other than gold in any quantity. Okay, the international lender of last resort is generally missing in action. We have had some extension of the key liquidity swap line for US dollars to central banks other than the 5 that normally participate in liquidity swap lines, but much of the world still falls outside this dollar funding network, and therefore is at risk of being cut off through international malfeasance. Okay, I have to get on with it because quickly on the digital transformation. Cybersecurity, I already mentioned the issue. It's quantum computing is going to be a huge digital challenge. not for all digital finance and beyond finance, not just DeFi. Central bank digital currencies are driven by a desire for financial inclusion. We still see too many people outside the formal financial sector, which is a source of economic inequality and also affects the effectiveness of monetary policy, I think. There's competition, growing competition for global reserve currency roles. The dollar is for the first time, I think, at risk of slowly losing out to other formative currencies, especially since it's used so often in countering illegal contraction and part of sanctions. Open questions here are, should it be centralized and account-based, which is my favorite solution, or should it be decentralized and token-based, put the CBDC on the blockchain? It can be done. It might be fun to try. It might be, but I think it is safer to have initially a centralized and account-based system. If DLT is chosen, the degree of pseudonymity provided to the digital wallet owners, whether it should be retail or wholesale. Well, if we choose the DLT route, the central bank's role will be wholesale only. They won't do the retail distributed ledger technology, I'm sure. And there's the possibility, and this is, I think, quite important, if we don't just add the central bank digital currency to the current menu of central bank money that's on offer, but if we take out cash, we remove the effective lower bound, zero lower bound on policy rates. Right? And that means that it would be as easy to go to minus 5% as to go to plus 5%. And that means that for the effectiveness of monetary policy in periods of low inflation will be greatly enhanced. And I'm in favor of the abolition of cash currency and replacement by its CBDC. Okay. As regards regulation, it's incredibly important to regulate economic functions, risk and returns, not based on institutions, not based on technology. Yes, you have to know the institutions, who does what and who. If to understand the technology, what matters is risk and returns. Okay, I'll come back to that later, but let's go to my last topic. Okay, well, this is just a summary of the regulation. Examples of what economic regulation, functional regulation means. Stablecoins should be supervised and regulated trackable bank deposits, right? As should money market funds for that matter. They should be allowed to pay interest, contrary to what the EU's market and crypto assets legislation has in store. Initial coin offerings are and should be regulated and taxed as initial public offerings, IPOs. These are securities. Just because they're offered on the blockchain doesn't mean they're not securities. And then non-fungible tokens can be digital ownership claims to anything. And it can be tokenized that way. And trading in these things should be regulated and taxed like all trading in financial and real assets. Technology should not get in the way of common sense. Okay, very briefly now, a few minutes on the inescapable fiscal dimension. Central banks, whatever their often bizarre formal ownership structure, right? I mean, the Bank of Italy is partly privately owned. The Fed, nobody knows who owns it. The board is a government institution, but the regional reserve banks are privately owned by the member banks. So it's completely bonkers. The Bank of England actually has it right. It's owned since 46, 100% by the Treasury. End of story, right? So, so the profits go to the government. They are beneficially owned by the government. They can provide loans, overdrafts, other credit facilities to the government. They can issue irredeemable liabilities with legal tender status. Some of these have zero interest. If we go to the CBDC, there could be negative interest rates on legal tender central bank liabilities. Their policy rates, of course, and their forward guidance influence the cost of servicing the public debt. So this inevitably makes them highly attractive sources of funding and a target for influencing for financially and fiscally challenged authorities. Now, why do central banks, even operationally independent central banks, buy government debt? Well, in the old normal, even before the effective lower bound became a binding constraint, right, we had routine open market purchases and sales. They were part of the implementation of monetary policy in the pursuit of price stability dual mandate. In the new monetary policy normal, when policy rates are constrained by the effective lower bound, QE and qualitative easing, yield curve control and forward guidance are the only monetary policy instruments left. They're used in market stabilizing operations, MMLR operations, market maker last resort operations. And we see that is necessary at times, even in the most liquid market in the world. Probably until the Fed defaults on its debt later in June because of the debt ceiling crisis, the Federal Reserve federal debt market is normally the most liquid market in the world. But in the space of a month and a half, the Fed purchased 1.8 trillion worth of US Treasuries and 900 billion worth of agency market securities. Right? So that market seized up completely and it needed stabilizing. Bank of England gilt market purchases, I already mentioned. And then finally, we have the monetary financing of government deficits and debt. Sometimes this can be consistent with the price stability mandate. I do not want central banks to be banned from buying sovereign debt, or even from buying sovereign debt in the primary markets of issuance, as the ECB and the Eurosystem banks are prevented from doing. Right? But some debt purchases are consistent with the price stability mandate, others are not. Here is the government budget constraint, just very briefly. The change in the debt to GDP ratio is driven by two terms. One, the famous interest rate minus the growth rate times the outstanding stock of government debt, D. And then second, by the augmented primary surplus. The primary surplus is the non-interest current transactions of the government, augmented because it should include seniorage revenue. Change in the money stock minus interest paid on the government money stock. So if the change in the non-monetary debt of the general government and central bank consolidated, very important, meaningful public debt sustainability analysis has to consider the consolidated accounts of the government, the general government and the central bank, not the general government separately. Okay. This government budget constraint, if you impose the condition that no Ponzi finance is feasible in the long run. Right? That you cannot always grow your debt faster than the interest rate on the debt. That's all no Ponzi finance means. That V condition then gives you this famous solvency constraint or intertemporal budget constraint of the state that says that the outstanding debt to GDP ratio has to be less than or equal to the present discounted value of future primary surpluses plus the present discounted value of future seigniorage. Right? The seigniorage again being the change in the monetary base minus any interest paid on the monetary base. So this looks like that, a painful and a painless way of servicing the debt. The painful way is primary surpluses. All this is discounted using the discount rate equal to the interest rate minus the growth rate. Right? That's what this notation means. Don't let it worry you. And there's a painless way, apparently, increases in the monetary base. Seigniorage. Right? Higher taxes or lower public spending is politically painful and economically often painful. Monetization would seem to be the painless option. Of course, outside Japan, until recently, and now even including Japan, excessive monetization means excessive inflation. We have seen massive monetization of public debt. Just to get a couple of examples of very rapid increases in the size of the balance sheet of the central bank. In Japan, the balance sheet pre-Great Financial Crisis was 16.5% of GDP. It is now 117% of GDP. It peaked actually in 127% in 2021. It's come down a bit since then. The Fed balance sheet gone up from 6% to 21% now. Again, it's come down from its peak. ECB, 111% pre-Great Financial Crisis, now in the low 40s. And the Bank of England, from just under 5% pre-financial crisis to mid-40s. Massive increase in the balance sheet and in the monetary base. This is the monetary base as a share of GDP. And here, a matching story, which really tells the same story, looking at the consolidated assets. And I'll just give you the Bank of England. It's still the last data point. Unfortunately, they published their balance sheet for the Bank of England data with a 5-quarter lag. God only knows why. But so I couldn't get the most recent data. It will undoubtedly have come down from 50, but still, to have a balance sheet increased by a factor of almost 10 between 2007 and 2021 means that all these motivations for purchases, including market maker of last resort, including quantitative easing, and I would say in some cases for the euro system, including fiscal capture, fiscal dominance, and monetary financing of the government there, has been a motivation. Sorry, I'm almost... Now, question. I showed you these intertemporal budget constraints of the government, which says that the debt to GDP ratio has to be less than the present value of future primary surpluses, but the discount rate is the interest rate minus the growth rate. Now, if the interest rate were to be less than the growth rate forever, you can have Ponzi finance, and the budget constraint goes out of the window. There is no budget constraint for the government. I think those who believe that this might be a solution to the problem are having to revise their views since the COVID crisis. And it made clear that both short-term and long-term factors are driving for lower ex-ante saving rates and continued robust investment and therefore likely upward pressure on the neutral real rate from its current 0.5% level, rather than getting it into negative territory. Okay. Now, when there is a conflict about monetary funding between the government and the central bank, the rule is governments win. I only know of one exception, the Bundesbank, because of the collective memories of hyperinflation. And I would have thought the ECB, because it has all the institutional independence, the formal legal independence, and it is one central bank facing 20 ministers of finance now. Right? So even the largest one, the German one, is a midget compared to the head of the central bank. But it hasn't been the case. I think the ECB behavior post-COVID is only consistent with fiscal dominance, fiscal capture. It's the only rationalization I can find for their interest rate still being at 3.5%. And there not being any serious attempt to shrink the balance sheet yet. I won't have time to talk about Argentina and Sri Lanka. They're examples of outrageous fiscal capture, where central banks were taken over effectively by the government and forced to monetize, leading to 100% plus inflation rates. Underlying fiscal problems were so serious that even monetization couldn't do the job, since a lot of their debt was foreign currency denominated. Both Sri Lanka and Argentina have had recent defaults. Argentina, its 9th sovereign default since independence. Sri Lanka, its 1st sovereign default since independence. Okay, let's finish up. With the euro area, I think the combination of the interest rate being only at 3.5% and the continued purchasing of vulnerable sovereign debt and the flexibility they have given themselves, even when they can no longer in the aggregate increase, say, the maturing principle of the PEP program, right? That they have the flexibility of reinvesting maturing debt in the debt of other sovereigns, which again means that they can and will, and in my view already are, effectively subsidizing the financially fiscally weak Greece's, Italy's, Spain and Portugal's of this world. Okay. What's required for central bank operational independence in the pursuit of price stability? Well, the only necessary and sufficient condition is effective political support for stable prices. Even when it is recognized that this could involve lower public spending and higher taxes. Unless there is a political consensus on that, central banks will give way to government pressure to monetize. Formal technical gimmicks like turning the central bank into an orthodox currency board, which can only increase the money stock when its reserves increase, that's all baloney. Right? Anything that can be legislated or regulated can be amended, repealed, and ignored. And has been. As the examples of Sri Lanka and Argentina very dramatically and somewhat more subtly, I think the ECB's example make clear. So, let me conclude then, this is my last slide. What are the tasks that central bankers have everywhere? Most I would say, have to relearn inflation control. They have to recognize that painless, immaculate disinflation is unlikely to be on the menu. The lender of last resort and market makers of last resort will have to be on permanent standby. Key asset markets are always at risk of becoming illiquid for whatever reason, including completely self-fulfilling, fear-driven, speculative runs. As well as local fundamental triggers that spread and become systemic when there is no fundamental reason why they should. The digital transformation is happening now. 11 countries already have a central bank digital currency. Admittedly, the largest one is Nigeria, but China and India are close, Russia is close, Sweden, Ukraine, United Arab Emirates and Canada, the Bank of England, I think, and the Fed, to an even greater extent, are significantly behind the curve. It's key to regulate DeFi and all new digital assets, including crypto assets, as economic entities in terms of their risk and return properties. Don't ignore the institutions and go see through them, see through the technology and look at the economic function. And finally, central banks have to be able to resist fiscal dominance. Government pressure for lower policy rates and for monetary funding of the government, whenever this is, in the view of the central bank, incompatible with its price level mandate. This should keep them busy for the rest of the week. Thank you.
I'd like to conclude by thanking you all for coming this evening, but most important of all, thank you to Professor Willem Buiter for giving us such a stimulating talk. Thank you very much, Willem.
Thank you. It's been a pleasure and a privilege. Thank you.